My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. Let me ask you a question. If you own your own house, your own home, do you still have a mortgage on it, or is it free and clear? There's some pretty crazy stats out there about the number of free and clear houses that are out there in the United States. I believe it's over 33 million or something like that, free and clear houses. So then the next question would be, what are you doing with that equity? Are you borrowing against it? Is that something you're kind of hesitating to do? Or are you looking for a different way? Well, we got two special guests zooming in from Vesta Equity. We got Michael Carpentier and Jake Kelley, who are going to be talking to us about a different way to access your equity in your home. So gentlemen, welcome to the show.
Thank you. Really happy to be here, Dave, and thank you very much for having us.
I'm pretty sure I got Jake's last name right. Michael, I should have double checked with you. Did I slaughter that, or was that all right?
You didn't slaughter it. You're pretty close, actually.
How do we say it?
I've had some pretty bad interpretations of it, but that was pretty damn close. So
well, I'm Canadian and I got a French last name. I should be able to say it, but I can't. So what's the proper pronunciation?
I noticed that Dave Dubois. I see you got to put the little accent in there as well.
All right, gentlemen. So let's talk a little bit about what you guys do at Vesta Equity. Michael, you were giving me a very good kind of overview before we pressed record, so I wish I could encapsulate that again. But tell me the big picture, big broad strokes. What do you guys do that's different than?
Yeah, I hope I do a good job again.
Yeah.
So essentially, how the concept evolved for Vesta Equity was in and around the idea that someone owns an asset, and their largest asset they own is very often their home. And it's where a lot of their wealth is stored. It's a misconception that people have these enormous stock portfolios and, big pension plans and whatnot. Most people have the wealth in their home. And there's only two ways really to tap into that equity, is to go to a bank and go into debt, or go further into debt, or to sell the asset.
So in other words, get a home equity line of credit, or get a mortgage on the property, or sell it.
Exactly. And those are expensive and disruptive to someone's life. And, they end up being saddled with monthly payments, which can affect cash flow. And at particular points in your life, you don't want to be saddled with monthly payments, particularly if you're reaching those retirement years and you want to age in place. So we've built a platform that enables people to tap into their home equity debt-free. And by doing that, we then enable investors to invest directly into that equity. And they end up being sort of like silent partners in your home. They certainly don't get residential rights or anything like that, but they're just participating in the future growth of an appreciation of that asset. So you end up in a very comfortable situation from your perspective. You end up being able to tap into your home equity debt-free, being able to use that equity for whatever purpose you may need it. You may need it for bridging your retirement income. You may want to make some investments. You may want to put your kids through university. All these things that you should be able to do because it's your equity, your home, your wealth. You should be able to do without any encumbrances. And
okay,
we facilitated them to do that.
Well, okay, so let's unwrap that, if you will. So let's say I've got a $500,000 house. Question number one, does it need to be free and clear before I can work with you guys?
Jake, jump in.
No, it doesn't. It doesn't. We do have when we provide funds to a homeowner, we do have a secured lien, a recorded lien on the home, but most often it's in a second lien position because the majority of homeowners do have an existing first lien mortgage on their home.
Okay, well, let's simplify it for this illustration then. $500,000 home, no mortgage on it, sitting on this sucker free and clear. How do I work with you guys to access my equity without it being debt?
So in that example, let's just say that you need $100,000 for some purpose. You want to send your kids.
Let's say I want my $500,000. Are you going to help me out with that?
You can't have the entire 500,000, unfortunately. You'd have to sell your house in order to get that. But we can provide some liquidity from the equity you built up in your home. In that case,
what would be the max on $500,000 free and clear?
Approximately 200,000.
So, okay, so 40% of the value of the home, max
That's
kind of
right.
thing. Okay.
That's often the case in a free and clear home. It depends on the balance of the senior mortgage, but fundamental
Free,
to
it's free and clear. There's no
it,
senior mortgage.
right,
So
no senior mortgage. And the reason why in that situation, the maximum amount you could receive would be approximately, 40% of the value of the home is because at some point in the future, likely when you go sell the home, you're going to need to repay that investment. And the way that we get repaid, since we're not collecting monthly principal or interest payments like a loan, is that we get paid back a multiple of the amount that we gave you. So using that same example, if we gave you 200,000 on a $500,000 home, we provided you 40% of the value of the home. At some point in the future, when you sell and you repurchase your equity from us, you may owe us 60 to 80% of the then value of your home.
of the then value of your home. Okay, so now it's starting
Right.
to come into picture here. So, all right, so I'm accessing a portion of the value of my home. I don't have to make any interest payments on this, but that accrues and accumulates and compounds over time. So when I do sell the house or I pass away and it goes to my heirs, then I pay you guys back plus interest at that point, correct?
No interest.
Yes and no. It's not interest and it's not accruing. It truly is an equity investment. But in practice, what happens is since we provided you 40% of the value of your home today, since we get no monthly payments, let's just pretend that your house hasn't appreciated at all. It's still worth 500,000. And the deal we struck was that when you settle, you'll have to pay us, 60% of the then current value of your home. So we will provided you $200,000. And at some point in the future, when you sell your home, you repurchase your equity for $300,000.
Got it. Okay, very good. So let's say it's that example, 500,000, you loan me $200,000 from that, and I sell the house in 5 years and it's now worth $600,000. How does that kind of look at the end of the day for me as the homeowner?
Right. So then if the deal that we had struck originally was that we'll provide you 40% today and we get 60% in the future, then we would
60% of the future value
of the
of the
future.
house.
That's right. So then in that case, we would take 60% of the new $600,000 value, which is about $360,000.
Okay,
So
so if I've borrowed the money for 5 years, that's pretty expensive money.
If you
um,
borrowed it, well, you're not borrowing it in this case. You're actually selling an option in your home on the future appreciation of the value of the
mhm.
house. So
Got
there's
it.
no interest accruing. But yeah, in the shorter term, this would be a more expensive alternative, depending on interest rates, right, Jake?
Mhm.
Yeah, that's right. And what's unique about our investment is the longer that it stays outstanding, meaning the longer time that the homeowner chooses to keep our investment before returning it, the lower the annualized cost of our capital becomes. So,
Depending on the end value of the house,
well, depending on the end
depending
value,
on what's
but
going on with the real estate market.
right. Yeah. If the
Yeah,
home is appreciated tremendously, then everybody benefits. We benefit as well as the homeowner. But if it in a situation where the home either remains flat in value or appreciates modestly, that the homeowner, if they repay us in 5 years versus 20 years, then the annualized effective cost of not borrowing, but taking our investment
accessing.
after 20
Mhm.
years is much, much lower than in the 5 year scenario.
Got it. Okay. I've got it. Thanks for explaining that, you guys. And I don't want to sound like I'm coming down hard on you because I'm an
Mhm.
investor. I get it. So the that's the benefit to me as the homeowner. I get the cash now, selling at a future date, paying depending on what the deal is that we struck. But in the meantime, you guys aren't really making any cash flow because I'm not making any mortgage payments. So how do you and the company make money? How do your investors make money in the meantime? Or do you have to wait the 10 to 20 years until the strike point for purchasing the house?
That's a good question. So our business model is very similar to any sort of private equity fund where we are managing capital on behalf of our investor base. And so at closing, we collect an origination fee from the homeowner as well as from the investor whose capital we're managing. And on a monthly basis, we're collecting servicing fees from our investor. And then once the homeowner repays the investment, we share in the profitability of that investment with our investor.
So who are the typical, well, let's look at two things. So you got two customers. You've got the homeowner that's got equity in their house that's working with you gentlemen to access it. And then you've got investors. So let's look first at who your typical clients are on the homeowner side of things.
Sure. So,
Yeah.
go ahead, Mike.
I'll answer the homeowner and you answer the investor. Typically, homeowners are urban professionals earning good income that want to access the equity in their home. They either have a high proportion of consumer debt as a result of student loans and getting through life,
Kids going through school,
kids
whatever.
going through school and stuff like that, and they want to actually tap into that equity to be able to pay some of that off. Or they're at a point in their life where they're nearing that retirement point, sort of that 55 plus, where they're realizing, I'm going to have to bridge my retirement income. I don't want to get a reverse mortgage because that's a typical example of interest accruing and accruing and accruing and accruing. And they want to be able to tap into the retirement income. Sorry, just tap into their home to bridge the retirement income. They're generally 55 plus at that point in their lives. But well-educated professional own homes that are on average 400 to $500,000. That's what we've been seeing, which is above average. And they tend to be financially well educated in terms of understanding what their options are, and they've explored their options. So they understand what it's going to take to get involved in a HELOC. Another example is oftentimes they're entrepreneurs or contract workers and they can't produce a W-2, so they won't qualify for a home equity loan,
Okay.
which is a big problem with a lot of people right now. And from a socio-demographic perspective, there's been a shift in the workforce and more people are becoming contract workers or entrepreneurs. And I think we're going to see a proliferation of that more and more. So there's that issue. They've been turned down for a HELOC. 40% of people are turned down for HELOCs for a variety of reasons.
Interesting. Hmm.
So they need to tap into their own equity. They need to actually tap into it because they need it for a variety of reasons. And then the last group typically are, as I mentioned to you, and not the last group, but that older demographic that need to tap into their home equity.
So what is the advantage of this? Let's say the older demographic, they're marketed to a lot with the whole reverse mortgage option. Why
Yeah.
is this a better choice for them versus a reverse mortgage?
When you do the math, reverse mortgages are very, very expensive. And not everyone will always qualify for them. And the upfront fees can be quite significant. Sometimes you
Mm,
could be looking at, $30,000 to $40,000 in upfront fees for a reverse mortgage, depending on the amount you're extracting out of your house.
mm.
And at the end of the day, it's very likely when you pass away, there's not going to be anything left in the home, and your heirs won't get anything from the asset. And it's expensive when you look at that compounding effect. You're not paying it out monthly in a reverse mortgage, but when you look at the compounding effect of interest, it becomes very significant. And typically, the interest rates for reverse mortgages are higher than you would get for your standard mortgage. They tend to be 1.5, 2 points higher on average. So that's a pretty significant interest rate, especially in today's environment.
Yeah,
And
most
I'll, if I,
definitely.
I'll just
Yep.
add one thing. The real killer of the reverse mortgage is what Michael said. It's the compounding nature of the interest rate. So in a reverse mortgage, if enough time goes by and your interest rate is, say, 9%, and that's clipping along compounding annually, and your home is only appreciating at, say, 2 or 3 or 4%, eventually that reverse mortgage is going to eat up all of the equity in that home, and the homeowner is left with nothing. Under our structure, that's not possible. So I mean, we always are entitled to only a certain percentage value of the home. So if the value goes up, I mean, there's never a situation where the homeowner is left with nothing in our structure.
Yeah.
Probably
And
not going to happen, but it happened in the Great
yeah,
Recession. What if you get involved in a home and the values go down at some point? What happens in that say? So let's say the
yeah.
$500,000 property 10 years from now miraculously is now worth $400,000. How does it typically work in that scenario?
Mhm.
Well, we're in it for the long haul. If you look at real estate prices over the long haul, they appreciate over the
Yeah.
long term. You're definitely going to get blips. You're going to get recessions. You're going to get economic upheaval. But typically, I think real estate prices, if you look at the last 50, 60 years, real estate prices have consistently gone up. But if it's a scenario where the investors made an investment in a house, you would have to go down quite a bit with the multiple for the
Yeah.
investor not to net out on the positive side, like quite significantly. And we've never seen that historically ever happen in the US market or other North American and Western democracies. We've never seen it fall that precipitously. So it's something that, yeah, it's always a concern. There's always a risk when you're making an investment in an asset, but that would be pretty damn big turnaround that would have to result for us
Mhm.
to have an investor
And a
walk out
long
of
term.
this.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
Yeah.
Okay, cool. Now let's take a look at the investor side. I think Jake, you were going to be answering this part. So, who
Mhm.
are your typical investors in your company, and how does it work for them? And what's like the minimum investment? What's the time frame they're typically looking at? Kind of
Mhm.
paint the picture from
Yeah.
that side, if you don't mind.
Yeah, sure. So the investor base for this asset class is a relatively new asset class. It's really only been around for about 3 years, but it's typically institutional investors. So you have some of your brand name private equity firms like the Carlyles of the world and Blue Owl and some of these groups who are committing hundreds of millions of dollars to companies like us to provide money to homeowners. So it's really at this point, it hasn't evolved into kind of the retail or accredited investor network. It's really kind of the big boys supplying large sums to the originators like us. And so how does it work for them? I always sort of compare it a little bit to a zero coupon bond where a chunk of money goes out on day one. There's nothing coming back on a monthly basis because we don't have any monthly principal and interest payments. And then if everything goes to plan, then a larger sum of money comes back at the end of the investment. And so for, if you run the math on that from the investor's point of view, like I was saying earlier, kind of the shorter time period, the higher annualized return, all things being equal.
Mhm.
But really, the reason why investors are the big institutional investors like this space is because it's really the only instrument that I'm aware of that allows homeowners to get access to true equity exposure in owner-occupied homes. So, I mean, there's big piles of money that invest in HELOCs and home equity loans. Those are debt instruments that are collateralized by the equity in home, but they're not actually equity investments that can benefit from kind of the underlying home price appreciation. So the only other avenue to get single family equity exposure is in the single family rental market. So you could go buy shares there's a REIT called American Homes for Rent and Invitation Homes. Those are rental homes that you can get equity exposure to, but the vast majority of household equity in the US is an owner occupied sector. And that is where there's, as Michael mentioned at the beginning of the interview, there's roughly $35 trillion of equity stored in US
Wow.
owner occupied homes today.
Yeah, and
Very,
that
very cool.
17, we estimate about 17 trillion of that is debt free. That's pretty
Yeah.
significant.
About
That's huge.
40% of homes
Yeah.
are owned free and clear in the
Yeah.
US.
Mind-boggling.
And to build off of what Jake just said about investors, we're building this platform actually on blockchain. So the goal is, yes, institutional investors now, but the way we're constructing this and the way we're rolling it out, eventually we want to open this up to a retail environment as well and let people participate in this as well. And also to leverage their home in unique and different ways. You don't necessarily have to sell the asset and then spend the money. You could sell the asset. You could literally convert your home into Bitcoin, essentially, if you wanted to. So if you were in a position where you're like, hey, I want to participate in the Bitcoin or Ethereum, explosion that's taking place, and how do I do that? I don't want to go tap into and draw against my investments that I have right now, but I got all this equity in the house. this is a great opportunity. So we're really trying to create a new way of homeowners being able to leverage that wealth in their home in different ways and then deploy that wealth in different ways. So it's a really, when you think a really robust ecosystem we're potentially building out based on home equity. We sort of call it the home equity economy. And it's significant because when you start expanding out globally, we're talking $278 trillion. It's 134 times the size of Bitcoin. And everyone gets so excited about Bitcoin. I'm like, yeah, it's great, Bitcoin. I love Bitcoin. But at the same time, I'm like, there's a much larger asset out there. And it's called residential equity. It's
It's
very,
a
very
little more
significant.
tangible.
Yeah,
Yeah.
exactly.
Okay, so as we're wrapping up, gentlemen, Michael, can you give me a 30-second synopsis of the big benefits of this for the homeowner? And then, Jake, I'll ask you the same question, and you give me the big benefits for the investor.
The homeowner gives them flexibility. It allows them to tap into their home, makes their home equity liquid, where they can tap into it and then take out that equity with no debt and not have to worry about those monthly payments. I mean, cash flow, we all face cash flow situations, and cash flow is not always fluid. And people do need to be able to access that wealth without having to go back into debt or without having to sell their asset. And when you look at the very significant population within the next 10 years, there's going to be 120 million 55 plus year olds reaching retirement age or in retirement age. They need to be able to have alternatives. They need to be able to tap into their home equity. And this allows them to do it. And it really does, at the end of the day, allow people to take that wealth they built out over years and years and years of commitment, payments, working hard to tap into that wealth and use it the way they want.
Perfect. All right, Jake, for the investor.
For the investor, it's pretty simple. It's access to a $35 trillion asset class that they've never had access to before. It's an opportunity to go long, if you will, on the U.S. housing market, betting on the equity appreciation in owner-occupied homes in a downside protected fashion and in a format that can be financed in an institutional manner in the capital markets. You can get these investments. You can borrow against them. You can pool and securitize them. You can create rated securities. It's a big boy asset, and it's the new kid on the block.
Perfect. Good summary, gentlemen. People want to find out more. Where should they go?
You should go www.vestaequity.net.
Perfect. Thanks for being on the show, you guys.
Thanks,
Perfect.
Dave.
Thank you very much. Thanks for having us.
All right, everybody, take care. We'll see you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.